So we've been talking about carbon all day. And we've been talking about various different solutions, various mitigation factors. Let's talk about how carbons can work as a market, how we're tracking. Here, there is both an abundance of information and yet somehow a shortage of information and data. We have too much, we have too little. I think, let's talk about how should we think about carbon removals, how they work today. Are carbon markets effective as they're structured today? And Olivia, maybe we'll start with you.
Yes. Well, thanks for having me. Delighted to have the conversation. I think it's a good extension of the conversation that you were just having. Just from a baseline perspective, the carbon markets today are bifurcated into two worlds. One is a multi-trillion-dollar marketplace, which is the compliance market. There's California cap and trade, there's Northeastern cap and trade system, then you've got a European system, you've got Asian, you've got Australian systems. That's a multi-trillion-dollar marketplace today. Highly commoditized, highly regulated, well understood. Then you've got this small but growing market called the voluntary carbon market. That is a well sub-trillion-dollar marketplace in the low single digits billion-dollar marketplace. And this is where I think there's an enormous opportunity to help meet the demands of Target and Lyft and other organizations that have these ambitious net zero goals and programs for the next multi-decade period. So what we're seeing today is the growth and opportunity in the voluntary market to kind of meet the standards and expectations in the compliance market to help really bring forth the opportunities in carbon removals beyond simply addressing the required compulsory marketplace that exists today. I think what we'll spend some time talking about today is the fact that so much of this market needs to evolve and mature into a space that you can legitimately call it a new asset class. An asset class where institutional investors feel confident to bring forth billions and billions of dollars into new projects that are doing incredibly impactful work from an environmental perspective and also from a societal perspective and community impact perspective. I see a lot of the carbon removal space as being an extension of economic development. So not only is there an environmental component, but there's also an economic development component of it as well. That's really focused on the nature-based side of the equation. There's incredible work that's being done with technological advancements. But from our perspective, I think that there's a great opportunity to see capital flow into nature in a way that really helps to be part of the mosaic solution of a net zero global economy.
Alexei, in that mosaic, where does Greenly fit and what problems are you solving?
Yeah, so I look at this problem a bit differently because I don't think you can look at carbon markets or removal without taking into account the big picture of measurement, reduction, and then offset. And while that may be kind of obvious, it's important to remind it. When you look at basically how we get to net zero, hypothetically in 2050, right, there will be 10 gigatons of carbons removed, but there's also 40 gigatons that need to be reduced. So at Greenly, we help about 1,500 companies track their carbon footprint. And obviously, the reason these guys are doing it is generally because they're mandated either by regulations or by customers of theirs that are asking them to disclose their emissions, but they are not mandated to offset. Their obligation is generally around the disclosure and sometimes the disclosure of how they plan to reduce, and they have all sorts of commercial incentives really to be doing this. The incentives are somewhat stronger in Europe, but they're here in the US as well. But the incentives for offsets are actually very different. So don't get me wrong, you do need to go from basically less than 1% of global emissions available for offsets to maybe 10%. So this needs to scale. But the cost of doing so is probably much higher than the cost of removal. and the availability of projects is much lower than the availability of reduction objectives. So I think this increased focus on reduction over offsets is just going to keep getting stronger with basically the regulations setting in the U.S. So the Senate bill in California or the SEC rule, as it mandates companies to start disclosing their scope 1, 2, and 3. What it's really going to be pushing towards is reduction rather than offsets, because a lot of the voluntary carbon offsets today have been basically promoted by companies who are only disclosing a fragment of their emissions. And if they start disclosing their full direct and indirect emissions, the cost of offset is also going to become much more, it'll be much harder to claim carbon neutrality and much costlier. So I think it's a great market, but let's not look at it independently, to summarize.
Maybe just to add on, I always like sitting on panels with folks like Alexei, because the way that I see it, and I'm a kind of a simple-minded person, is he's the liability side of the equation, and once you know your liability, you're going to need to find an offsetting asset to match it. And if we can speak that language, we can understand how these markets relate to each other. The asset doesn't start, you don't start with the asset to say that that in and of itself is the accomplishment. You have to start with understanding what is your liability, what is the extent of the problem that you have, how do you reduce that liability over time? The objective isn't to stay with a maximal liability. The objective is to reduce your liability over time. But the reality is you're going to need to have an asset to offset whatever liability you have. Or many companies seek to have an ambition to have their liability matched by an asset. And I think that if you kind of take that framework and think about it in terms of the two sides of the ledger, a liability and an asset, the objective function is to reduce your liability as much as possible. But unfortunately, the reality for any company is that you will have residual carbon emissions in your business activities. There are not enough technologies today, there's not an ecosystem around us today that allows a company to operate with no carbon liability. Do I think in the future there'll be a case that companies can operate freely like that? Absolutely. That's the ambition that we all have. But I think when you start to do the math and you understand that mosaic, the reality is you always have some liability. You're going to need a Greenlee to help you figure out what that liability is, to then determine if it's the right strategy to then create an asset for you to match that liability, to have that kind of net zero balancing of the ledger.
So it seems to me in either approach, we need to, do we even have agreement on like what the value of the asset is globally? Because when we talk about these markets, there's an effort in the US, there's an effort in Europe. Do we at least agree what the value of the asset is itself?
Absolutely not.
Well, I think we're now at a stage where carbon accounting is pretty well standardized. I mean, there are, of course, lots of subcategories where there are question marks as to how to best compute emissions from your supply chain and so on. But the general methodology is standardized and it's globalized already, whereas carbon markets mean actually a lot of different things. You have people claiming carbon neutrality because they funded carbon avoidance projects where the emissions avoided are based on a scenario analysis of what could happen, which sometimes is somewhat dubious, hence some of the press backlash on offsets last year. But then you have real carbon capture, and then you have the avoidance project cost a few bucks for a ton of CO2, and then the direct air capture cost $1,000. So it still feels like basically the regulations have kicked in for the accounting, but they are there in a sense for the compulsory carbon markets, but there's nothing really for involuntary offsets today. I expect it's something, I know the EU is looking at regulating this because there are lots of developers, right, buying land in the Amazons. There are issues with local communities not getting properly paid and so on. So it's really, I think, a place where you want to bring some regulatory clarity, and you want this to scale, but if it cannot scale in its present form because it creates a lot of suspicion from well-meaning companies as to the honesty of a lot of these projects, to be fair.
Yeah, definitely. So no surprise, the European thinks it should be well regulated.
Well, I don't want to be a caricature, but you don't want to pay for something that's not real, and that anybody can understand.
There was this sort of backlash where I think a lot of companies were looking for carbon offsets as an easy fix.
Yep.
And they got called on the carpet for it, and now we're looking for something more sophisticated.
Yep.
What do you see the path forward? What's the way to make that work in an honest and fair way?
Yeah, the way that I would have framed it is this kind of get out of jail free card. I think a lot of companies were utilizing the carbon markets and utilizing, frankly, some of the cheaper parts of the carbon markets to get out of jail free. And that's just not right, and they're getting kind of punished from a reputational perspective as a consequence of that work. To take the valuation question and kind of dig into that for a moment, I don't think this is a bad thing. I think it's just how this market works. The compulsory market is a reference point to kind of singular units that are deeply commoditized, and people can trade and buy and sell very seamlessly because each unit is treated absolutely the same. There's no difference of price for one compulsory security in that market versus another. There's no differentiation that's seen. In the voluntary side, I see it more like a traditional, for me, I come with a fixed income background, so I think about it in terms of the types of bonds that are in the world. You know, it's not fair to say that all bonds are the same because they're not. You know, you can have the U.S. Treasury issuing a bond, you can have an emerging market country issuing a bond, you can have a corporation like Microsoft issuing a bond, and you can have a high yield issuer of a bond. That's all just in the public markets. It's not to say any one of those prices is wrong. It's just within their asset class, within the bond universe, they're priced differently. And we see the same thing in the voluntary markets. There are certain types of projects and program types that have some pricing features to them, direct air capture and a technology-enabled solutions. Some people are paying $800 for a ton of carbon removal. That doesn't mean that that price is wrong versus a REDD+ project that's more of an avoidance credit that's trading for a couple bucks a ton. It just means they're different asset classes. And then you have different vintages, which I think of as kind of like different interest rates or different coupons that are associated with the bonds. So if you come with that kind of matrixed view of the world, you can start understanding pricing a little bit differently. The last comment would be, what you are seeing is that companies are, particularly those who are leaders in the space, are taking very seriously the concept of quality, integrity, and their own due diligence in these projects. No more are you seeing companies just kind of taking off the shelf from whoever wants to provide advice on what carbon credits to acquire. Instead, they're looking for really a white glove service, a white glove moment to say, this is a project that I, large Fortune 100 company, can stand behind. I know it will stand the test of a Wall Street Journal scrutiny because I've lived it, I've breathed it, I've been there at that project, and that's the type of attention I think a lot of the big Fortune 100, Fortune 50 companies are applying to this space now.
Do you think that, in the business coverage that I've seen, I can certainly see the pendulum swinging against ESG investments for a lot of these reasons. How far do you think it's going to go, and is there a best path forward for companies?
Well, on that, we've seen that ESG, of course, encompasses a lot of different dimensions. And by the way, that's something that's really not standardized at all. Yeah. Every rating agency basically has its different weighting on what's important or less important. So it totally dilutes the carbon aspect of things, and it has been shown that most of the otherwise financial rating agencies, there is basically zero correlation between those ratings and carbon. So I think it's actually a completely different conversation. It also highlights the fact that there is no proper carbon rating system out there today. And so today, if you're an investor and you want to, and you're looking for signaling as to where you should be investing in companies that are actively reducing their emissions, it's very hard to do. You rely essentially on the information that companies themselves provide to you. But what would that rating look like if it actually existed, right? I think the base signaling that people have relied on, and which is very misleading, is companies claiming to be carbon neutral, because I measure on part of my emissions, or sometimes only scope 1 and 2, and then I offset, and it's a good intention, right? But you're forgetting usually a big chunk of it. But if you do just that, it doesn't really tell you that this company is moving in the right direction of net zero. So what this is missing is the accounting, the actual action that's being put in place, the real year-over-year reduction, and the pathway that this company has defined. There's a good framework for this, which is Science-Based Target Initiative. Tells you the reduction pathway that each company, according to its sector, it's supposed to do year over year. So look, we measure this individually for companies, but there has yet to be an aggregated rating system on this, which, by the way, needs to encompass offsets as well, because it's part of the different levers that you can use.
So I have a mental image, and just go with me for a second. So we've got this kind of pendulum swing moment, right? So the natural question is, where are we in this pendulum swing? It feels like we're swinging back 10 years or something like this, right? But when I kind of go through the global landscape, I see each country has their own pendulum. And the U.S. pendulum is definitely swinging back. I speak to my friends at large asset managers, and unfortunately, they're getting letters from attorney generals from some of the major states that you would think of, about ESG and sustainability practices at the asset manager and threatening to pull significant amounts of money and actually pulling the money. So in the U.S., there's definitely a pendulum swing that's happening. But outside of the U.S., in the European markets, and Alexi will attest to this as well, the pendulum is still being cocked in one direction, and it's still being heavily focused on sustainable finance. Australia is the same, Singapore the same, other parts of the Asian marketplace, Latin America, not exactly sure where they are in the spectrum, probably mid-swing in the pendulum right now. But I think when you think about it from a global landscape, and then you think about trying to operate a global asset manager or a global company, you unfortunately, or actually fortunately, have to play at the highest standards, because if Europeans are demanding one level of operations for, just take an asset manager for a moment, you have to comply with all of those activities. It's not like you tell the 30% of your company over here, like, don't touch anything that we're doing as it relates to ESG data or ESG research or engagement. It doesn't work like that. You have to operate at the highest playing field. And so what's really fascinating to me is to watch that continued lean in from the European regulators, who frankly, put some pretty lofty ambitions and objectives into the marketplace without really knowing how to get there, but nonetheless, it's great to throw the gauntlet out. They did it, and they're kind of backing into how do you solve for it. And frankly, that is lifting the standards for everyone else, even if the pendulum is swinging in the opposite direction in the US. The reality is you're all going to have to play at the highest common denominator if you want to operate globally.
But again, ESG doesn't mean at all the same thing in Europe and in the US. I mean, it took me a while to find out that there was supplier diversity let's hope we can finish this conversation. But it took me a while. I couldn't understand the backlash in the US until I saw that there were, it was part of the anti-woke debate and stuff, so which is totally absent of the European conversation. So they look at it, and also the weighting is much more on the carbon in Europe than on the other criteria. So I think people are essentially not speaking the same language on this one.
Yeah.
So?
No, I agree. ESG it's an enigma, and it can be pretty much anything you want it to be, which is why it's lost a lot of its potency here in the U.S. Yeah. But if I can see a common thread between the two of you, it sounds like you both think that there should be if we had a way to track emissions standardized globally, that would be a step in the right direction. Is there any timeline for when you think it sounds like it's going to happen eventually? How soon can we expect something like that to be put into place?
Well, if I may. Today, it's been measured that there are about 25% of global emissions that are tracked and managed. It's essentially the enterprise who are doing it on their own, and then they make assumptions about their supply chain. Yep. And that kind of covers it. If you look at the regulations already voted in, so the CSRD in the EU is essentially adding, it's going from 10,000 companies to 50, 55,000 companies having to do it. So that should get you from basically 25 to maybe 35, 40% of global emissions. It includes 5,000 US companies with large enough operations in the EU to have to comply. And it starts next year, basically. I mean, you'll report into 25 your emissions of 2024. The US, the Californian Senate bill, which I think is expected to be signed by the governor, should add 5,000, an extra 5,000 US companies, probably the same ones, by the way, who will be subject to CSRD. So it's happening, but the question really is, and that's the movement that we observe in our particular business, is this trickle-down effect from enterprise to mid-markets, even SMB companies, because they make assumptions about their supply chain, but you also get to a point where organizations are mature enough to actually want to reduce their emissions. So assumptions are not good enough, and so they include this stuff in their procurement. So these regulations really have a much further reach here. So I assume, in the next 5 years, you'll get to 45% of global emissions, and I think in the next 15, 20 years, you'll get to 100%. So, and that will solve part of the problem that you don't have enough data on the companies that you're working with on their emissions to figure out your own emission, right, as a customer of theirs. So, and that's obviously work in progress, and it's necessary because it'll be super hard to reduce emissions if you are not measuring them, basically.
Olivia, you want the final word?
Sure. I think that there's a common language for how to identify what your carbon emissions liability is. The question is, who is mandating that you communicate that and track that information? And that's what Alexi is getting to, is there's not enough companies who are required to do this. Most of the companies in the Fortune 500 and our large public companies are tracking and monitoring this information, and frankly have teams that are building those institutional capabilities inside. It's the rest of the population out there that hasn't quite caught up yet. My intuition is that a lot of these private equity portfolio companies, venture capital portfolio companies, the private equity firms, the venture capitalists, the private credit firms are going to start demanding more of their portcos, and that will help if you don't see sufficient regulation move the needle.
Excellent. Thank you both. This is very
Thank you very much.
conversation.